You've been hot and heavy into the dividends, more the deep value stocks. That has played well for you and your clients. Are you sticking by that strategy, or does this week's fairly positive stock action change your mind in any way about how to invest right now?
Well, Sully, you're absolutely right. I am constructive. We look at the dividend-focused portfolio, but the points that you touched on, it's been a historic week. We finally have the Fed meeting in the rearview mirror. We are very focused on President Biden and President Xi conversation to continue that distancing away from Russia. That has been a relief in the marketplace. But what's interesting, Sully, for the first time, we have seen 3 consecutive 1% gains in the S&P 500. That's really relieved a lot of anxiety, has pushed the VIX down to about 26. And if you go back all the way to 1950, when you see 1% gains in the marketplace, about 90% of the time, we do see the market move higher, and that one-year return, Sully, on average is about 20%. So I do have some optimism. I do have some constructiveness, but we are focused, absolutely. Look at names like Chevron, Coca-Cola, Truist. It's a nice cross-section there. That dividend yield for those 3 holdings on average are about 3.25%. And we have seen a lot of risk mitigation when you own those dividend-focused names. So that is a tilt we are going to be moving forward with to close out the quarter.
Yeah, I'm not going to call those names boring, but some of them may be considered a little bit boring, at least compared to some of the high-growth technology names, although Chevron has been trading like a tech stock along with a lot of other energy names as of late. Is that kind of a sign, Jeff, of how you see the entire markets this year, which is just return of capital, get some capital appreciation if you can, get some dividends, get through 2022?
Well, I think we have to digest the fact that it's really hard to take this myopic view, but inside of all this volatility, so we expected higher volatility. It's a midterm election year. But to your point, we are focused on sector rotation. We do understand that energy, industrials, financials, we have seen this shift from growth to value. So yes, there's going to be volatility. It's not going to be a straight line, but I am optimistic, and I think we will see a lot of the returns. Historically speaking, going back 85 years, Sully, all the returns in a midterm election year come right before that certainty of November. So I think it is going to be continued volatility, but there's a lot underneath the surface that has constructive tilts towards it. So we have earnings season coming up. Yes, we're focused on Ukraine. I'm not diminishing the humanitarian tragedy or the economic ramifications, but I do think right here, right now, this is the time after you see a 10% correction in the S&P 500, a 20% correction in the NASDAQ 100, you have to be selective. You have to be a stock picker.
I know you're not a short-term trader, not for sanctuary wealth, maybe for your own personal portfolio, Jeff, but I mean, it looks to me like in others that the market is trading inverse to oil. Oil up, stocks down, oil down, stocks up. What do you think of that relationship? And if so, how do you see that playing out in sort of the near and medium term?
Well, it's a great point, Sully, and you know I've traded a ton of crude oil futures in my career. And when you see that correlation go to 1, I think it really is important. So you have the opportunity to sell puts in some of these names when you do see a big drawdown in the crude oil WTI futures, but also you have to take profits. When we saw crude oil go up to $130, we knew that was a knee-jerk reaction. We knew that was a speculative catching people off sides. So you have to absolutely be nimble, and you can utilize ETFs, futures, or options. We like using options. I personally like using options to define my risk. I want to understand what I potentially can lose, but also have that upside, that reward waiting for me.